Hello and good morning. I'm Ken Leon, Director of Equity Research at CFRA, and we're delighted you could join us today for the webinar on our outlook for 2022 tapered expectations. I will be the moderator, and with me today is Sam Stovall, Chief Investment Strategist, Vincent Randazzo, Chief Market Technical Analyst from Lowry Research, part of CFRA, Matthew Miller, Vice President, Equity Research in the materials sector, and Todd Rosenbluth, who heads up our ETF and mutual fund research. Next. First, a disclaimer, this presentation is for information purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. I would also point out as you look at your screen to the right that you can fire away and send us questions via chat. And then also the slides are available as a handout in the handout section as well. Next slide, please. Again, here is our lineup of presenters today. It is a great lineup, well known, great experience across the whole team. And we're going to take advantage of the full hour to get all great content into our discussion for Q&A at the back part. Next slide, please. So with that, let me turn it over to Sam. Good morning, Sam.
Good morning, Ken. Good morning, everybody. Thanks for tuning in today. I'm going to be talking about these tapered expectations. But I guess before we start talking about what might sound like sort of a downer of a call, let's go to the first slide and see how well the market has done. Certainly with the action yesterday and what seems to be going on today, you can add to the performance that the S&P experienced through Tuesday the 14th. S&P was up more than 20%. All sizes, styles, and sectors within the S&P 1500, along with 90% of the sub-industries were also in positive territory on a year-to-date basis. So naturally, the question is, gee, if the S&P has gained more than 20%, what does that imply for the coming year? If we go to the next slide, we can actually see a variety of things in terms of price performance 1 year. What does that imply for the next year? Basically, in summary, what it says is that 2022 will probably be a good year, but most likely not a great year. When you think about great years or those of 20% or more, in the following year, the market gained more than 10% on average, 10.4 to be exact, and was higher 80% of the time. Both the price change and frequency of advance was better than the average for all years since World War II. It was also in the top 10, number 3 to be exact, for the number of new highs experienced this year at 67. What does that imply? About a 9% advance in the subsequent calendar year, but with about a 70% frequency of advance, so a little bit less. We're also in the second year of a president's term in office, what is called the sophomore slump. In that case, the market is up about 4.95%, and the frequency of advance comes down a bit as well. And then finally, we are in the third year of this bull market, or at least we will be come March of this year. And typically what we find is that the third year is the most challenging of bull market years, rising only 4.4% on average. So depending on which indicator you look at, it can be as good as 10.4% or as weak as 4.4%, implying that history repeats, and obviously there's no guarantee it will. But one thing is fairly certain, and that is the volatility tends to increase, not only on an annual basis, but also on a quarterly basis. In that sophomore slump of the president's second year in office, the market has seen an increase of volatility, or I should say volatility that was 40% higher than the average of the other 3 years. Specifically, if you look at the second and third quarters leading up to the midterm election uncertainty, we see that volatility is 30% and 80% higher, respectively, as compared with the other 14 quarters of the 16-quarter presidential cycle. But you can't really say it's going to be a bad year because we're expecting solid GDP and earnings growth, even though we have the headwinds of inflation, but we are forecasting an inflation peak for the first quarter of 2022, even though we are also now looking, obviously, for higher rates as the year progresses. But another headwind will likely be a potential PE multiple contraction for the S&P 500 in this rising interest rate environment. So let's look at some of the specifics. If we take a look at the next slide, we will see the 16 quarters of the presidential cycle. The first grouping is the average price change, and the right-hand grouping is what is the average standard deviation of returns for this going back to World War II. And I highlighted in blue that the second and third quarters are the only ones of the 16-quarter presidential cycle that have actually posted average declines. For the full year, 4.9% is not very good when it's compared with the other years of the presidential cycle. And then if you look at second and third quarter standard deviation of returns as well as the full year, you can see that 30 and 80% higher volatility for the second and third quarters versus the other quarters of this 4-year cycle, as well as the higher volatility for the second year as compared with the other years. So just sort of advising investors, those who might be emotional in nature, fasten your safety belt. It could be a bumpy ride, but we will obviously get through it. And if you look to the fourth quarter of the second year, as well as the first quarter of the third year, those are the two strongest quarters of the 16-quarter presidential cycle. So whatever weakness we experience going into 2022, history then says it'll be worth it because we then tend to bounce once the uncertainty of the midterm election has run its course. Let's take a look at the next slide, which shows we have a 12-month target for the end of December of 2022, a target of 50-24, which is a mid-single-digit advance. Our belief is that because of the increase in inflationary concerns, increase in interest rates, et cetera, that it could be a good year, but these headwinds will hold us back from being able to record another double-digit advance. We see earnings rising to above $220 a share for the S&P 500, which represents about a 7.5% gain. Revenue is up 7.1% for next year. Real GDP growth, 4.8% is our forecast versus 5.7% for all of 2021. In terms of inflation, we think that the peak will actually be in the first quarter of 2022 at 6.9%, a little higher than the ending of 2021 at 6.7%. But then we think the inflation rate will be cut more than in half and will be at 3.2% by the fourth quarter of 2022. The Fed funds rate, well, we think that the Fed will be raising rates at least twice, possibly 3 times, as the dot plots implied with yesterday's release from the Fed. We also see the 10-year note rising from about 150 today to about 190 or so a year from now. Because of the higher interest rates, will make our fixed income a bit more attractive to foreign investors, and so we could see an increase in the value of the Federal Reserve's major dollar index. And then lastly, as we expect to see the economies improving around the globe, that should again put upward pressure on oil prices. So we expect to see it averaging around $83 and change by the end of next year. So what about earnings in particular? Let's take a look at the sectors and cap sizes within the S&P 1500. So on slide 9, please, we can see what the earnings expectations are. First shaded blue column is the estimates for 2021, a very good year, up 44% for the S&P 500, about 81% for the mid-cap 400, close to 140% rise for the small-cap 600, and all sectors seeing an advance over the prior year. The reason for the not meaningful with energy is because in 2020, energy actually lost money. If we look to the individual quarters, yes, we can see an introduction of some declines because it's going to be very tough comparisons with 2021. For the full year of 2022, S&P 500 should likely be up 7.7%. Mid caps up a little better at 7.6%, small caps up close to 10%, with double-digit increases being seen in consumer discretionary, energy, and industrials. So good earnings growth expected, certainly as we are looking at things right now. Obviously, one of the main concerns that investors have is inflation and its impact on the overall market. Let's take a look at the next slide, which looks at, basically takes all of the inflation data going back to 1949 and puts it into quintiles. And for every year-on-year increase in the headline CPI month over month, so meaning every month you compare the year-on-year change in headline CPI with the prior month's value, and whenever it went up, what happened to the S&P 500? Interesting, but the S&P stayed in positive territory all the way up to 5.5%. Beyond that line in the sand, if you will, on a prolonged basis, the market did not do very well. So the market continues to advance, possibly because it is looking across the valley, looking into 2022, in which inflation is expected right now to dip back below the 4% level and average about 3.2% in the fourth quarter. But if we take a look at the box in the upper right, you can see by decade what the market did and also what the challenges were. If we take a look at the decade of 1951 to 1960, we started that decade with a year-on-year gain in headline CPI at 8%. By the end of that decade, it was at 1.4%. So not surprisingly, with inflation coming down fairly dramatically, the compound annual growth rate for the S&P 500 was 13.5%. If, however, this decade ends up looking more like the 1970s, we could be in for trouble. Back then, we started the decade at 5.3% and ended the decade at 12.4%. Not surprisingly, compound annual growth rate was only 1.6%. And once Paul Volcker then strangled inflation, things started to get better in the 1980s and 1990s. Let's take a look at the next slide. Shows a little more detail as to the year-on-year changes in headline CPI. And there were 5 periods prior to this one in which we had the headline CPI number touch at least or even exceed 1 standard deviation above the mean. So basically going into a level of excess. And that's what we've seen just recently, where we're now in that 6th period since World War II of extreme inflation. So what typically happened from the market perspective? Well, let's take a look at the next slide, and you can see that it was not always a negative ride in terms of these inflation spikes. During that full period, the market was up almost 32% from January of 1950 to April of 51, because we then fell precipitously thereafter. In the late 60s, early 70s, we just eked out an advance. But then in the early to mid 70s, because of the OPEC crisis, we ended up falling into a fairly hefty bear market. The 1980s, again, because we were sort of treading water, up about 3.5%. But then just prior to Iraq invading Kuwait and us falling into another bear market, we also saw some price declines. Looking at market decline counts, The 5 to 9.9 is what I call a pullback. The next one is a correction, and the 20% plus is a bear market. And you can see that in each one of these inflationary spikes, we did suffer through 5 pullbacks, 6 corrections, and 3 bear markets. So there is a good possibility that we experience at least a pullback, if not more so, as we head into 2022. Let's take a look at the next slide to see traditionally which sectors ended up doing the best. So again, looking at the headline CPI year-on-year number, comparing it with the prior month, whenever that occurred, how did the sectors within the S&P 500 perform? Not surprisingly, energy and materials, 2 inflation hedges, did very well. But a lot of investors might be surprised to know that technology actually did fairly well also, possibly because of their fairly low debt levels, fairly low dividend commitments, and also if companies are looking to improve profit margins, they're going to invest more heavily in technology to improve the profitability of existing employees, et cetera. So probably not a surprise that technology in the long run does fairly well in higher inflation. Not surprisingly, financials have not done well whenever we have seen a narrowing yield curve. Utilities and the old telecom services, meaning AT&T, Verizon, the very high-yielding utility-like stocks, did not do as well because of the interest rate competition from these bond surrogates. Consumer discretionary also did not do as well, certainly because the higher the cost to borrow, the more reluctant consumers were to borrow, to go out and spend on housing, autos, clothing, etc. But let's take a look at the next slide, because we are getting to that point in which the Fed will start to raise interest rates. The orange bars, the very high returns, show how did the market perform 6 months before, 6 months after, and 12 months after the first rate cut by the Federal Reserve. So you can see very nice returns by the market whenever interest rates were headed downward. But what about 6 months before, 6 months after, and 12 months after rate hikes? Well, interestingly, I guess investors tend to whistle past the graveyard, as you would say. The market tends to advance on average about 7.7% in the 6 months before the first rate increase. But once we have a rate increase, the market has gained only 1.3% on average 6 months later, and was posted a below average annual return of only 5.1% 12 months later. The encouraging thing is that the market has still been positive on average 6 and 12 months after the first rate increase. However, the performance has been quite muted when compared with periods after rate cuts, but also after all periods going back to World War II. Let's take a look at the next slide, which shows the PE ratios at every point in which we have the 10-year yield. If it's between 0 and 1%, the PE ratio has averaged 22.5 for the S&P 500. Between 1 and 2%, it averaged 18. Between 2 and 3, it averaged 15.5. Started to climb up a bit to the 6% level, but then work its way downward once we went higher and higher on the 10-year note yield. The basis of this is to show that essentially there is a downward slope. The higher the interest rates go, the lower the PEs on average that the market will experience, or at least will be able to tolerate. So as a result, as the Fed starts to raise interest rates, our belief is that we could end up seeing some PE contraction along the way. Now, where does that leave us in terms of sector recommendations as we stand right now heading into 2022? Well, let's take a look at the next slide, and you can see that we're still leaning toward the cyclical and growth areas because of that 7.7% gain that I had mentioned, usually before 6 months before the first rate increase. Also, we are in a seasonal soft spot, or sweet spot, I should say. November through April, the reverse of the sell in May period, tends to be fairly strong for the market. While the S&P has gained an average of about 7% going back to 1990 in this 6-month period, the cyclical sectors, in particular information technology, materials, and others, have gained about 9.5% on average. However, the switch usually takes place in the May through October period, when investors would tend to perform better by gravitating toward the more defensive areas. But right now, as we head into 2022, we're still sticking with communication services, energy, tech, and materials, and suggesting an underweight to staples, real estate, and utilities. So let's head to my summary slide, where I mentioned that, yes, the market has entered a near-term seasonal sweet spot, and that encouragement will come from rising GDP and earnings information, but we still face an awful lot of challenges ahead as it relates to inflation, interest rates, and historical cycles in that period before and after rate increases, as well as PE multiples and a rising rate environment, et cetera. Cyclical sectors have performed better November through April, but then the market tends to get a bit more defensive May through October, because the early strength in the midterm election years typically gives way to weakness in the second and third quarters. So to help us now get a better feel for what the market is telling us from a technical perspective, I now turn it over to Vincent Randazzo from Lowry.
Great. Thanks, Sam. Excited to be here. Really excellent perspective, and I think it coincides a lot with what I'm seeing, but from a different angle. So I think that's interesting. Let's start with the first slide, please. And in this segment, I'll be evaluating the trends of the forces underneath the price indexes. So as simple as it sounds, demand and supply. And I say demand and supply, not supply and demand, because it's typically the behavior of the buyers that changes first and tends to be more valuable. So think about it this way: at any given time, there are literally millions of different reasons for investors to sell stocks, but there is only ever really one reason to buy. And after assessing the current market using these three groups that we're going to talk about, or pillars of the Lowry analysis, the market's message is that it's losing vitality. So that means that investors should be more selective in their portfolios, focusing on high quality stocks, mainly large caps, with the sturdiest demand and relative strength profiles in the strongest industries and sectors. And this is important, as Sam pointed out, since it is a distinct departure from the environment of late 2020 and the first half of 21, when losers were really hard to find. If we go to the next slide, we'll start with the overview of those pillars of our analysis. The primary driving inputs of the Lowry analysis, developed in 1938 to disaggregate and visualize the forces of stock market's demand and supply, are buying power and selling pressure. And we incorporate over 24 other indicators to provide context, with some of the more valuable ones listed here. Generally, these indicators fall into three groups: demand and supply, breadth, and momentum, all of which work together to identify important market turning points and also to keep the shorter term market gyrations in the right perspective. Because market tops are processes, not events, if investors monitor these indicators, not just prices, they're able to adapt to the changing environment before it becomes apparent in the price indexes, which frankly is often too late. So if we could please turn to the next slide, I'll elaborate on Lowry's measures of demand and supply. Based on the historical observation and the Lowry mantra that the index prices alone can often be misleading, the proprietary measures of buying power and selling pressure place an emphasis on what's going on beneath the surface. Because the problem with the major price indexes is that they are market cap weighted, or in the case of the Dow, price weighted mega caps. This means that it can be difficult to gauge the true condition of, let's say, the average stock or the overall market if the large cap leaders are still behaving well, which is often the case near the end of bull markets. So the construction of buying power and selling pressure puts the onus on the many stocks, not the few, to assess the health of the investing environment. Let's go to the next slide to look at the current snapshot of demand and supply. And what's apparent from this chart, and certainly if you hold a portfolio that isn't like a large cap price weighted index or price or market cap weighted index, is that beginning in about mid-March, the market became more challenging than the price indexes would indicate. That's around when buying power peaked. Selling pressure bottomed shortly thereafter in mid-May. And from then on, the market experienced several swift rotations that led to multiple Lowry intermediate trend buy and sell signals. Now, our buy and sell signals are mechanically generated, but taken into context. And our most recently issued sell signal from November 26, when selling pressure moved above buying power, that remains in place. The interpretation right now is that investors should call some weak stocks, raising some cash, while focusing more on the high quality stocks with strong demand and relative strength profiles. Now, a new intermediate trend buy signal is going to be registered when buying power crosses above selling pressure. But as sort of a precondition or a caveat, if the short-term index does not reach at least a semi-oversold level beforehand, it'll be considered a weak signal and historically with a low level of profitability. And that has been the case with all buy signals since July. And you know how the market, for the most part, or at least a lot of the stocks in the market since then has really struggled during that time. On the next slide, we'll cover market breadth or stock participation, put another way, and I think that is the best way to think about it. So market breadth basically just measures how many stocks are participating in the bull market. Bull markets with strong breadth tend to go further for longer than those with poor breadth. Broad-based advances also make it easier as a portfolio manager. Basically, the probabilities of picking a stock that's going up are just much higher. So in the battle of supply and demand, we say that the large cap relative strength stocks are the generals and the soldiers are the rest of the smaller cap stocks, are really what make up most of the stock market. And the most favorable conditions for buying are when the soldiers are following the generals. So everybody's moving in the right direction. One of the ways we measure this, and one of the oldest gauges of market breadth, is the advanced decline line, which is basically just a running tally of the number of advancing issues. And in addition to gauging the ease or difficulty of the investing environment, breadth indicators often warn of coming market corrections and bear markets. So they're really useful in that way. Negative divergences between the advanced decline line and the price indexes happen when the price indexes keep making new highs, but the breadth measures start trailing down into the right. And that reveals, really in essence, that there are fewer stocks participating in the bull market. Over the last 100 years, 90% of bull markets were, bear markets rather, were preceded by these negative breadth divergences. And that gave, of course, advance warning if you knew what to look for. And the last point that I think is important to make here is with reference to these negative divergences, those divergences lasting more than 4 months historically tend to precede the longest and usually most damaging bear markets. Let's go to the next slide. We'll examine the current situation in breadth. And we talk about breadth with using the advanced decline line, usually the NYSE all issues advanced decline line. But our analysis takes that measurement another step further. Since the all issues advanced decline line is populated by a lot of preferred stocks, closed-end bond funds, and foreign ADRs, the all issues can sometimes track the health of the bond market better than the stock market. Now, don't get me wrong, it's still an excellent indicator, but at times it's going to miss because you do have different things going on with interest rates at the end of cycles or into declines. And I think a good example recently of that is from January to late February of 2020, when Lowry's OCO advanced decline line, or operating companies only advanced decline line, did have a negative divergence warning that something negative is potentially in the works there, and the all issues advanced decline line did not. So in terms of current stock participation, after having experienced divergences in late summer resulting in a shallow pullback, Lowry's breadth indicators have been really sluggish to recover. And in fact, a negative divergence started to reappear against the S&P 500 with its most recent high on the 10th of December. So that's something we're just going to have to watch. And this just reinforces the observation of a more selective investing environment. There are just fewer stocks that are going up on a day-to-day basis. The next slide will illustrate the weakness, where the weakness and strength is more pronounced. And this data set is basically just a segmented advanced decline lines, and that enables us to see which parts of the market cap structure are leading, lagging, following, or diverging. Classically, small caps, being the most sensitive of these three, tend to diverge first, leading the way to the downside ahead of major market tops or even corrections, with that weakness usually spreading to other segments along the way. What we can see here is that small cap breadth peaked in early June, and really this is a warning that not all stocks are marching in the same direction, and it no longer paid to go out on the risk curve. The message is clear. There are more small cap stocks declining than advancing. So if you're looking for new stocks, it's best to avoid small caps. Instead, looking to the large caps, which really has been the leadership segment for most of the bull market, is the place to go there. Now, that's not to say that you can't find small stocks that are strong, but know that it'll be a lot more difficult to find them. Let's go to the next slide to dig just one step further into stock participation. Breadth, using the advanced decline line is great, but it's limited since it only tracks the directional participation, not the associated demand intensity or weakness in those directions. Lowry's percent of operating companies only 20% or more below 52-week highs measures the latter. And just note, while we're looking at this chart, that series is plotted in the bottom panel on an inverted scale. Since the multi-year low on the 15th of March of 9%, that number has continued to grow with each successive new market high. That's not a normal or healthy setup. In fact, as of the S&P 500 high on December 10th, the percent of Lowry's stocks 20% or more below 52-week highs was 32.5%. So let's just reflect on that a moment. A new high in the S&P 500, and almost a third of stocks are basically in a bear market type drawdown. I just think that's a really powerful thing to think about, just how deceptive that big cap index can be at times. And not to suggest a similar outcome, but I think it's interesting to know when you look back at history, on the final Dow Jones high on September 3rd, 1929, that figure stood at 31.8%. So to counter what most people believe at bull market tops, where there's just this raging party, historically at the final bull market high, these figures are already elevated, as those very big, safe, popular stocks tend to hold up the indexes. Now, looking ahead, once the percent of OCO stocks 20% or more goes below or above, actually above 50%, the forward intermediate term returns are really challenged. Typically, these readings accompany drawdowns, corrections, bear markets, whatever you want to call them. And since 2001, following the initial break above 50%, that line of demarcation, the S&P experienced consistently negative returns on a 1 and 3 month forward-looking basis. It reached 41% on December 1st at that little low there. On the next slide, I'll tackle the last of the three groups of indicators, momentum. Most people, when they hear the words market momentum, especially in the world of technical analysis. Think of the hottest stocks. But what I'm referring to is the number of stocks that are actually just in uptrends. The percent of stocks above their 10 and 30-week moving averages just depict just that, how many stocks are in intermediate and long-term uptrends. These indicators are basic reflections of market health and strength during advances. And they are very adept at identifying important market bottoms. So they're very good at demonstrating where those reversals are from lows. But on tops, they're a lot more difficult to identify, just given how gradual the formation of market tops historically are. It's a process, not an event. So you see a lot of degradation before a top is finalized. Just makes it a poor timing tool. But when you do see persistent divergences in momentum indicators, they are helpful in identifying just the fact that you have a more selective and therefore increasingly vulnerable market environment. So although they're not great timing tools, they do provide important information to investors. Let's go to the next slide for the current momentum trends. With the most recent high in the S&P 500 met by a reading of just 57% in New York Stock Exchange issues above their 30-week moving average, which is about 150-day moving average, it's become really difficult to find stocks in long-term uptrends. So again, important information to know if you're a portfolio manager or any kind of investor. It's just a lot more difficult out there. This doesn't obviously represent a favorable new buying environment. More important, it's really not a new phenomenon. After reaching some of the best levels we saw in years this summer, the percent of New York Stock Exchange issues above their 10 and 30-week moving averages have been declining even as the price indexes rose. Once again, this is not a healthy market condition. And this brings me to the summary slide, just tying all this together. The bottom line is that the current market conditions are indicative of a weakening bull trend. This environment demands investors take care with their equity holdings, focusing on high quality stocks, primarily large caps, with the most favorable demand and relative strength profiles, ideally from the strongest industry groups within the strongest sectors. Again, just trying to make it easier on yourself as an investor to go to those stronger areas of the market. So again, it's important to know that despite being near all-time highs, beneath the surface, the damage is piling up. So just understanding this and adjusting portfolios accordingly, I think will be critical in navigating the likely more challenging year to come in 2020. So with that, and up next, with a focus on the basic materials sector, an area that has actually been improving according to Lowry's measures of demand and relative strength, is Matt Miller.
Yeah, thank you, Vincent. Now we will highlight CFRA's outlook for metals and mining, an important industry during periods of higher inflation. On our first slide in this section, we provide an overview of the materials sector. And as Sam illustrated earlier, materials is considered an inflation hedge sector, as companies in this sector are selling really the same commodities that are often driving higher PPI and CPI figures. And this has really been the case in this cycle as well, with surging prices for everything from lumber to plastics to industrial metals. Macro themes that are impacting the supply and demand for key materials include infrastructure and a shift to renewable energy. And of course, China's impact can never be understated. And recent flare-ups of its credit crisis have brought up once again worries about a Chinese hard landing. And our top picks within metals and mining include two steel names, Cleveland-Cliffs and Carpenter Technologies, as well as two major copper producers, Freeport-McMoRan, a pure copper play, and Teck Resources, a diversified miner with significant copper exposure. And lastly, MP Materials, the only major rare earth miner in North America and soon to be a producer of powerful rare earth magnets as well. On the next slide, we highlight the strong performance of the metals and mining industry in 2021. up 33% year to date, although we know it has been a roller coaster ride with high volatility. In fact, you can see metals and mining was up as high as 54% back on June 1st. And it has really been a great year for industrial and base metals, especially copper, steel, and aluminum, which has been partly offset by weakness throughout the year in gold miners. Next slide, please. For domestic steel producers, 2021 has been a record year for sales and earnings, driven by steel prices hitting new all-time highs. But steel prices have peaked and are now trending down. And the question for investors is how far and how fast will prices decline? And for that answer, we need to look at the capacity utilization and lead times. Steelmakers curtailed their production last spring when the economy shut down, and the utilization dropped from 80% to around 50%. And steelmakers were not able to bring capacity back online quick enough to really catch up with the V-shaped recovery in major steel consuming markets, construction and automotive, as well as manufacturing. And so lead times earlier in the year, they hit record highs. The average lead times for hot rolled steel at 10 weeks and coated products at 12 weeks. That's more than double what is typical. And today, the capacity utilization is around 82%. It has approached as high as 85% in recent weeks, and that's the highest level in decades. Recently, steel prices have been declining as the mill lead times have narrowed back to historical averages, and prices should continue to correct lower in our view. And this is supported by new capacity expected to come on stream. However, demand is also poised to increase from higher infrastructure spending, and we highlight that on our next slide here. Steel consumption directed towards infrastructure-related spending is around 53%, and that's combining the construction and the machinery and equipment segments of this pie chart. We expect construction spending in both the public and private sectors to continue growing quite healthy, driven by single-family housing and expanded federal and state infrastructure funding. In November, Washington signed into law the long-awaited infrastructure package. That's a $1.2 trillion bill that reauthorizes a new 5-year highway bill, and the additional spending from that over the baseline levels is $550 billion. The most direct way to gain exposure to infrastructure in the materials space is Vulcan Materials, Martin Marietta Materials, Eagle Materials, as well as Summit Materials. Steel names, however, are also poised to benefit, and we forecast the impact from the infrastructure package to be incremental demand that will average 5 to 7% per year for the next 5 years. And if automotive also remains strong in 2022, the average steel price next year could surprise to the upside, and the steel sub-industry could post another strong year. Let's now move to the next slide where we highlight our top picks in steel, Cleveland-Cliffs and Carpenter Technologies. Cleveland-Cliffs has really undergone a major transformation from solely being an iron ore producer a few years ago, and they acquired their 2 largest customers, AK Steel and ArcelorMittal USA. And Cleveland-Cliffs has now become a fully integrated and, in fact, the largest flat-rolled steel producer in North America, with strong exposure to automotive, but also good exposure to construction markets as well. Carpenter Technology is a niche producer of specialty alloys. Carpenter's largest end market is commercial aerospace, and its products are found in nearly every airplane platform, both narrow body and wide body. Carpenter is uniquely positioned to benefit when aircraft build rates and associated engine build rates return to strength. Let's now move on to copper. This next slide shows the copper price in both 2020, the orange line, and 2021, which is the blue line. The copper price hit a new all-time record high of $4.75 per pound in May of 2021. The price has fallen from its peak, although it's still at historically high prices. And in fact, since May of 2021, the price has averaged around $4.35 per pound. We are forecasting continued strength in the copper price, driven by strong incremental demand, mostly from decarbonization themes, and underwhelming supply growth. We forecast copper to trade in a range of $4 to $4.75 per pound for most of 2022, but we expect it to enter 2023 above $5 per pound. On the next slide, we highlight the biggest source of long-term incremental demand. Copper is used to increase the efficiency of electrical technologies, from motors to transformers and solar and wind energy systems. And a shift towards renewable energy should be a long-term secular tailwind for copper, as wind and solar energy projects, they require 4 to 6 times as much copper per megawatt. And as renewable energy grows, so does the need for energy storage, which is also very copper intensive. Electric vehicles are poised to significantly increase future copper demand. EV demand today is only really scratching the surface of its impact on the copper market. Copper is used extensively throughout EV components, from the motor to the inverter, as well as electrical wiring. And EVs can use up to 4 times as much copper when compared to cars with internal combustion engines. We forecast copper consumed for decarbonization in markets will grow from only 1.2 million metric tons in 2021, or around 5% of global demand, to 2.6 million metric tons in 2025, and that would be around 10% of the market at that time. So the demand fundamentals are very bullish for copper, and so are the supply fundamentals, which we'll look at on the next slide, please. As copper demand has been resilient, global stockpiles have continued to decline. And this really runs contrary to any negative sentiment concerning a slowdown in China. During the last 5 years, lower inventory levels combined with higher demand has resulted in a consistent decline in inventory days, which is the number of days that global consumption can be met by current inventory levels. Days inventory finished 2020 at around 19 days of supply, and we forecasted around 15 days currently and at the end of the year, well below the long-term average of 26 days. We expect higher supply from mined copper from new and existing projects to help the supply situation in 2022 and 2023, but will it be enough to keep up with demand over the medium to long term? And we'll look at that on the next slide here. The supply response in copper is not as easy as some other commodities. Oil, for example, had the technological advancement of hydraulic fracking, and today it's very easy to drill for new wells in the Permian Basin and quickly increase supply. In copper mining, however, assuming you have found a good ore body from exploration, it can take up to 10 years to construct a new mine. And world-class copper discoveries are also extremely rare. You can see here the average age of the largest 10 copper mines is 100 years old. And many of the top mines are located in Chile and Peru. And moving on to the next slide, you can see how important these two countries are to copper supply, two countries facing significant geopolitical risk. And when you include the DRC and Zambia, half of the world's copper supply is from regions facing higher geopolitical risk, which is really causing mining companies to rethink investing in new mines in these regions. So there you have it. Higher demand and supply constraints, in our view, is very bullish in the short and long term for copper. And on the next slide, we highlight our top picks, Freeport-McMoRan and Teck Resources. Both of these names really should have top tier production growth. Freeport from its Grasberg mine, and Teck Resources from its expansion at Quebrada Blanca, which is set to double Teck's copper production when fully ramped up in 2023. Now let's transition to gold. We have a more neutral outlook on gold. 2020 was an exceptional year for precious metals, but the risk on trade removed much of the enthusiasm, and gold fell from near-term highs. Recently, gold has found strong support in the high $1,700 per ounce range. Back in 2015, CFRA upgraded our outlook on gold from neutral to bullish, and we were 1 year too early because gold didn't really gain traction until the following year. And just 2 weeks ago, we've moved our outlook on gold back to neutral, and we were about a year late on that call. Gold investments this year have been nothing but a drag on performance in 2021. We entered 2021 thinking that gold could continue to appreciate, noting the fundamentals in our view supported higher prices, as you can see on the next slide. The money supply surged by $4.2 trillion during a 12-month period ending in February of 21, and that was an increase of 27%. That's the largest 12-month increase in the money supply since 1943. And since February, the money supply has continued to increase an additional 8% through October. And for reference, quantitative easing following the 2008 financial crisis averaged only 6% per year, and that was from 2010 through 2019. And now in a 2-year period, we've increased the money supply by 40%. Typically, this currency debasement is exactly what gold prices would like, argue for bullish prices, but we think the risk-on sentiment and the strength of US dollar has kept gold from moving higher. And we also note that gold and other precious metals is losing meaningful market share to cryptocurrencies when investors are seeking alternative investments or a hedge against fiat currency devaluation. And these factors really kept gold prices below $2,000 an ounce, even as real interest rates have continued to fall. And we illustrate this on the next slide. The most powerful driver for gold prices over the last 50 years has been real interest rates on the 10-year Treasury. And that's showed as an inverted line in orange on this chart. A shifting interest rate policy environment will likely be a headwind for gold in upcoming years as central banks begin to raise interest rates. So far, rising inflation expectations has been met with expectations for higher rates, and therefore, the real yields could have already troughed, and that means that fewer, if that's the case, then there could be fewer positive catalysts for gold in 2022. At the same time, we note that gold can continue to play an important role in risk management. Next slide, please. We often highlight gold as the ultimate diversifier, as it is an uncorrelated asset relative to most major asset classes. And this holds true during recessions and expansions. Gold adds diversification and liquidity, and history shows holding gold enhances risk-adjusted returns. This is because of lower volatility, of course, but absolute returns for gold have also been strong relative to other assets. On the next slide, I show that there are many ways to gain exposure to gold, depending on risk tolerance and outlook on the precious metal. You can physically buy gold, but that would require you to store it in a safe location. The most popular option and the least risky one is a gold-backed ETF that tracks the price performance and also eliminates the cost of storage. Gold miners provide the best leverage to gold price movements, but also is the riskiest way to play gold. And the in-between option is to invest in a precious metal royalty or streaming company. Now, these companies help finance the upfront costs in exchange for a royalty or metal stream. Effectively, this provides investors with upside from prices and exploration while limiting operating risks. We don't have any strong buys in gold, but we do have 2 names with 4 stars or buy recommendations. And those are Wheaton Precious Metals, which is in the royalty and streaming segment, as well as Agnico Eagle Mines in the mining segment. And that concludes our outlook for metals and mining. I will now turn it over to Todd.
Thanks, Matt. Great to be with everybody. We can just jump on into the next slide here. I head up our ETF and our mutual fund research, and it's been an amazing year in the ETF market. We are approaching $900 billion of net inflows this year. We were at $800 billion at the end of November. We were just over $500 billion for all of 2020. So we've set a new record. We actually hit that record in July, and demand hasn't slowed down. You can see the heavy lifting has been done within the equity space, more than doubling the net inflows for the year. Fixed income ETFs are neck and neck. We could hit a new record by the end of the year, but it's really been the equity ETFs. On the next slide here, I want to just highlight that it's not just index-based ETFs. That's the original products tied to the S&P 500, the Barclays, or now the Bloomberg Ag. But we've seen actively managed ETFs are now actually pulling in nearly $1 in $7 of new money in 2021. It's not just it's not just passive products, but active ones, both in the asset gathering and, as we'll see here on the next slide, the supply of products that have been coming to market. 2020 was a big year for actively managed ETFs, but 2021 has been an even bigger year with firms like Dimensional Funds, Fidelity, JP Morgan, Nuveen embracing the ETF wrapper. So people tend to think of ARC and the thematic-oriented ETFs within the active space, but there's some heavyweights within the mutual fund world that have been climbing. We'll move one slide forward if we can to just remind you about who the key players are and what the success those products have had. Dimensional Funds rolled over a mutual fund, converted it into an ETF. That's why they have over $14 billion of new money. I'm going to highlight BITO, which was the first Bitcoin price-related ETF to come to market. Matt touched on earlier about the demand for cryptocurrencies. There certainly was demand for a Bitcoin-related product, the first product to hit $1 billion in 2 days. now has about $1.4 billion in assets. And you can just see a range of different firms that are out here offering actively managed and popular ETFs. Let's move one slide forward if we can, to just be able to remind you how we at CFRA rate ETFs. It's a more forward-looking approach. We take the fundamental research from Matt and Ken and the broader equity research team. We combine that with our forensic accounting research. We blend that in with some proprietary data on fund flows, on the performance, on the cost, to provide a star rating that can help you going forward into 2022, not just reliant on the last 3 years. I use that as a background as we move to the next slide. I'm going to give you a couple of examples of ETFs. Matt touched on one of them in his slide as a way to get exposure to the gold mining space. That's GDX. You can see it focuses solely on gold mining companies like Newmont. It's had a pretty good 3-year track record, but a pretty poor 1-year record. The contrast is XME, which is a more diversified metals and mining oriented ETF. You can see exposure to steel, aluminum, diversified metals companies, as well as gold. Track record on a 3-year basis is a little bit weaker, but much stronger in the past year, as Matt touched on the strength of some of these other commodities, not just steel. And then my last slide I want to bring us to is to touch on a bit of what Vincent was talking about, of focusing on higher quality companies. And that's important in 2022, both for US as well as international investing. On a recent Market Scope Advisor thematic research piece, I highlighted some of these alternatively weighted ETFs, IQLT, which focuses on blue chip high quality companies with strong balance sheets, consistent earnings growth, and VIGI, which looks at companies such as SAP, Toronto Dominion Bank, Sanofi, that have raised their dividend for 7 consecutive years, and in many cases look appealing to us going forward. You can see the track record and cost structure here. These are 4-star or 5-star rated ETFs. The CFRA, this is just a way to get international exposure, but with a twist focused on higher quality companies. And with that, Ken, I'm going to bring us back to you to be able to take audience questions and wrap up.
Oh, thanks, Todd. And we do have a few questions, Sam. One question really about, how defensive should we be, and whether should we go all cash, in Q2 or Q3 of next year with the important midterm elections coming up, Sam?
Well, that's a good question, Ken. I rarely advise people to be moving their portfolios to cash. I'm a big believer that you're better off rotating than you are retreating. One of the things that I talk about is, how does the market tend to perform in those midterm election years? Now, going back to 1990, in the May through October period of the second year, the S&P 500 actually fell 3.4%. So in May through October of the second year of a president's term in office, yes, the market was down about 3.5%. But interestingly, the consumer staples and healthcare sectors were up 5.6% and beat the market each of those observations. Of course, we're looking at fewer than 10 observations going back to 1990, but it does show, using S&P 500 sectors, by hiding out, if you will, in those areas where the demand for the products and services remains fairly static, has been a prudent move during these challenging quarters.
Great, Vincent. One question is, what should we be looking for in the next rally and going forward? Should there be a reverse? And a reverse, if we were looking at the S&P 500, do we see support at the 4,100 level, which would be about a 10% correction?
Yeah, that's no, it's a good question. I think that the bottom line is that the S&P will do what it's doing, and it won't necessarily mean as much. We just really need to look at all these indicators behind and what we were saying there. So I think the first thing is just to see a reemergence from the small caps. I think if you think about the small caps, there are just, in terms of numbers, there are just multiples more small cap stocks than there are large caps. So just by virtue of numbers, they're important. They're important to breadth. They're important to the way that Lowry measures demand and supply. So if we can have any kind of relative strength out of small caps, that would be a really good sign, especially if it is sustained for multiple months, because we just haven't seen that at least for about 8 months at this point. So that'll be really important as just a generalized statement. And then more specifically, we're going to want to see a sharp withdrawal in the percent of stocks down 20% or more. We're going to want to see an expansion in the number of stocks, at least within 10% of new highs. And along with that, we're going to want to see the expansion in particularly the percent of stocks above their 30-week moving averages that I highlighted there, minimally above their most recent high, which was about 68%. But like we saw on the slide, healthy advances, truly healthy bull markets make highs and see 75% or better in that reading. So that's when you really are able to achieve something healthy. In terms of the reversing to the downside and where could that go? It's really not something that even as as technicians, the way we do our analysis, it's not really something that we pay too close attention to, because we know what we're looking at is not necessarily representative of what people hold in their portfolios or the average stock. But certainly just from a traditional technical perspective, you would not want to see 4,300 breached to the downside. That would really change the complexion of the environment in a way that would be definitively more negative, because that was the low from early October. That was that early October low.
Great. So Matt, iron ore prices and maybe even copper have had wild rides in 2021. What is your thinking for 2022 as you look at global demand and in particular China? And how does it play with your recommendations of major miners like BHP Group, Rio Tinto, and Vale?
Yeah, no, it is a great question. Our outlook presented today was focused on the domestic steel industry, which, thanks to Section 232 tariffs and quotas, is somewhat insulated to global steel trade. In China, the tight steel production controls that happen due in a way to try to curb emissions, those should really remain in place. And this really is a headwind for the global iron ore producers, which it does mean lower steel production in China. And that's actually, that's a good thing for the domestic steel producers that I've highlighted today, because that means less steel imports competing with domestic supply. But for BHP Group, Rio Tinto, and Vale, companies that generate the majority of their profits from iron ore, it is a serious headwind because China really drives the seaborne iron ore trade. And this headwind, arguably, however, is baked fully into the valuation of these names. And despite some challenging fundamentals, that doesn't mean these names should be ignored. Iron ore prices trading today at over $100 is still better than historical average. We expect them to trade below $100 per metric ton in 2022, but still historically not that bad. And the balance sheets and dividends have never been stronger for these three names. We do have buy recommendations on BHP and Vale.
Great. And Todd, last question for you. Following Fed meeting and Chairman Powell's comments about inflation, how should investors use ETFs to protect their portfolios in 22 or beyond? And what are some of the interesting funds that tie into the inflation theme?
So we've seen inflation-related bond ETFs be extremely popular in 2021. About $40 billion has gone into these products. They collectively manage just $100 billion. So we've seen the assets accelerate. These are products like TIP, from iShares or VTIP from Vanguard. I'd highlight one equity ETF that came to market this year. The ticker is INFL. It's a Horizon Kinetics Inflation Beneficiaries ETF. It owns equity companies or stocks that have favorable exposure to inflation. So companies that are in the energy or materials sector, or the exchanges within the financial space that are asset light that can benefit from this. So this is a new ETF. It's one we already cover at CFRA and has been gaining traction. The ticker again is INFL.
Great. Nicole, if we can go to the last slide. First of all, I want to thank our presenters for a really comprehensive, great job looking at the outlook for 2022. And importantly, I want to also thank each of you for attending this event and taking time from your valuable schedules. To learn more, obviously, these were a short amount of time, but to gain more about Sam's views about the equity market, or equity research from Matt Miller and team, or Todd, you can go and visit Market Scope Advisor, and you can certainly get more information about this should you not be a subscriber and look into a trial. Lowry Research also has trials available for Vincent and his team's research, which importantly speaks to technical investment services. So with that, I want to wish each of you first a thank you for joining us through the year, wishing you a safe and happy holiday, and we'll be speaking to you in the first quarter of next year. Take care.